Okay, good morning, everyone. Thanks so much for joining us. This is 2021 Self-Directed Account Breakdown. My name is Sean McKay, and this is an American IRA presentation. And so we thought we'd do something a little bit different with this webinar. So as we look at the calendar today, it's March 15th. So we're actually exactly 1 month away from the April 15th tax deadline that a lot of individuals adhere to. So we thought it'd be a good idea to try and be a little bit proactive with kind of communicating some of the important elements as it pertains to IRAs, 401Ks, and then also some accounts such as Coverdale's, health savings accounts, to give you kind of some broad strokes as to how to think about these retirement accounts during this kind of tax season here. So certainly first and foremost, as is always the case, please keep in mind that we are just simply the record keeper for retirement accounts. And so ultimately, we're going to lean heavily on your tax and legal professionals to fill in the blanks and really look at your specific situation. We're not going to make any sort of suggestions today as to what retirement account is appropriate. Certainly, we all have a lot of factors that go into that. But hopefully there's some good information for you today and kind of a general starting point to have those discussions, especially with your tax professional as we're getting into this tax season here. So our headquarters is in Asheville, North Carolina, and we have a satellite office in Charlotte, North Carolina as well. So really today is kind of one of those quick hit webinars where we're really just going to delve into a specific topic. But just as an overview for those of you that are not yet clients, we do have kind of a unique dual proposition for working with clients in that our fees are really unique for the self-directed space and our customer service is really tremendous. So from a fee perspective, we're set up very differently. Our annual fee for account balances that are over $7,500 is $285 a year. It's not based upon the size of the account or the number of assets that you hold. And as you can see from this chart, that can get very expensive as your account balance grows in the self-directed space, or as you accumulate additional assets. That can be a little bit cost prohibitive at a certain point. So certainly keep your eye on that as you're identifying the right self-directed provider. And then again, as I mentioned, from a customer service perspective, we're really proud of what our team does on the operations end. They do a phenomenal job servicing accounts. So whether you're looking on Google reviews, Better Business Bureau reviews, or any of the other platforms, we're really appreciative of the positive things that our clients have been saying about us. So we'll go ahead and get right into it. So we're going to start with the idea of the traditional retirement accounts, the traditional IRAs. And so these are retirement accounts for individuals that are looking for a tax-deferred vehicle. So in many situations, you're going to get a deduction on your annual tax return by making contributions to this retirement account. So these are pre-tax retirement accounts. Now, conversely, when you pull money out of these retirement accounts, hopefully in your retirement years, you will be taxed on the distribution on the way out. And so ultimately, that is, again, a very personal decision as to whether you want to pay taxes on the way in or on the way out. But a traditional IRA is a pre-tax vehicle. For individuals under 50, you can contribute up to $6,000. For individuals 50 plus, you can get $7,000 into the account. And so with that, with the traditional IRA, you can actually make your contribution for these traditional IRAs up until April 15th for your 2020 contribution. So again, we're in March 15th of 2021. So at this time of the year, assuming you had earned income of at least $6,000 for 2020, you can still make your 2020 contribution up until the tax deadline there. You can also do a spousal contribution, even if your spouse is not working. So if you're looking, let's say there's two So you have two individuals in your household, spousal situation, and you have just simply one individual in the house that has a W-2 or a 1099 income scenario. As long as you've made at least $12,000 that year, you could actually make a contribution for each spouse. And so each would be able to have their own traditional or frankly Roth IRA in that situation. So that's something to look at. Now, there are income limits, as we saw in the previous slide, and you'll be able to take these slides with you. This is recorded. So depending upon whether either of the spouses is eligible or has the capacity to contribute to a employer-sponsored plan, that will determine whether or not you get your tax deductions for that year if you make a certain level of income. So you definitely want to check that out. The RMDs, required minimum distributions, those start for pre-tax retirement accounts like a traditional IRA at 72 years old. Essentially, the government says you have to start taking money out of your retirement account. And so essentially, it's going to be April 1st of the year after you turn 72 is when you'll be required to take your first required minimum distribution. So again, 2020 contributions we can make up until April 15th. If you've already made your 2020 contributions, you have until April 15th of 2022 to be able to get those 2021 contributions in there. So the next retirement account is the Roth IRA. So fundamentally, this is the other side of the coin. The traditional IRA is a pre-tax vehicle. So many times you get a deduction by putting money into that retirement account. Conversely, with a Roth IRA, this is a post-tax retirement account vehicle. So again, for individuals under 50, you can put $6,000 in. For individuals 50 plus, you can put $7,000 in terms of a contribution to that retirement account. Now, it's also important to note with these retirement accounts, there's really two ways we can grow these accounts. There's the ability to make these contributions, which we're certainly capped at the amount we can put in from our wages each year. But there is not a limit to how much we can grow the account. So if you're able to make a prolific investment and turn a $6,000 contribution into a $50,000 gain from some investment, then that is certainly allowable. So the IRS does not state that you can only grow the account so much, just simply how much you can put in from your wages each year. Now, just as we have the deduction phase out for the for the traditional IRAs, we also have an income limit for our Roth IRAs. And just as we do with the traditional IRAs, this is based on the MAGI, so Modified Adjusted Gross Income. So this is a calculation that your CPA can assist you with. And so for individuals that are married filing jointly, if you make less than 198K MAGI, then you're going to be able to make that full contribution to that Roth. Singled or married filing separately, you're going to be, as long as you're under 125K MAGI, you can make that full contribution. Now, what I will say is, again, this is a discussion to have with your CPA, but if you're in a situation with the traditional IRA where you're above the income limit to get the tax deduction, you might want to speak with your CPA about making the contribution to a traditional, but then doing a conversion to your Roth, what's called a backdoor Roth. And the reason for that is you're not getting a tax benefit anyways by putting monies into the traditional IRA, so you might as well grow the monies tax-free and be able to pull the monies out in a tax-free fashion in your retirement years as you can with a Roth IRA. And so again, if your income limit is too high to directly contribute to a Roth, you might want to investigate initially opening and contributing to a traditional, and then just simply again doing that Roth conversion so that you end up with that Roth account if you're in a situation especially where you're not going to get any tax deductions for a pre-taxed contribution, if that makes sense. Now, as is the case with the traditional IRA with the Roth, you have until April 15th of 2021 to make your 2020 contribution. So really critical to understand some of these accounts, the April 15th deadline is a hard deadline. For other retirement accounts, you actually have extension periods to be able to make those contributions. So really critical to understand that difference. So the next one is the solo 401k. And so this is an interesting retirement account. This is for the small business owner that does not have full-time employees. And so again, this is a discussion to have with your CPA, but there's essentially two carve-outs for that. If you have what's considered a quote-unquote highly compensated employee, you might be eligible for a solo K. Or if you have a spouse that is actually materially working in the business, then you will typically be eligible for the solo 401k as well. Now with this, there's two components to a solo 401k. There's a salary deferral component, and this can actually be pre or post-tax monies. So think pre-traditional, post-Roth monies that you're putting into the salary deferral. And then there's also a profit sharing bucket inside of this solo 401k as well. And so with that, those will always be pre-tax like a traditional IRA in terms of the contributions being put into this. Now with the solo 401k, if as of the time of this recording, if you have not yet established your solo 401k, you would not be able to make contributions for 2020. So essentially the solo 401k had to actually be established in the year 2020 in order to make the contributions. Conversely, the Roths and the traditionals that we spoke about, you could be establishing that account between now and certainly you don't want to cut it too close, but before April 15th to be able to set up and fund that retirement account. And the RMDs are in place for the solo 401k just as they are for the traditional IRA as well. Now there are some caveats to the RMDs for business plans such as a solo 401k. If you're currently still employed by the company and the plan documents allow it, sometimes you can actually push out the RMD schedule for when you have to start taking those required minimum distributions. Again, definitely something to discuss with your CPA. So this is kind of a visual of the solo 401k contribution bucket. So with the employee bucket, for individuals under 50, you could contribute $19,500 to this account, again, either pre or post-tax. If you're 50 plus, $26K, and that could be the first monies that that business makes. Now, the profit sharing contribution is going to be 25%, or it's going to be 20% if you're a sole proprietor or a single member LLC. So you can get up to $37,500 into that component. So combined max contributions, you're looking at $58K if you're under 50, or $64,500 if you're 50 plus and the income allows for that. So the next small business plan is a SEP IRA. And so this is an account that you can utilize if you're a business owner and you do have full-time employees. Now this acts very similar to a solo 401k in many ways. There are some differences. We talk about this on the solo 401k presentation where if you want to use leverage for retirement accounts, a solo 401k is going to be a more tax efficient vehicle than a SEP or the simple IRA that we'll discuss next. But this is a pre-tax vehicle. Now with this, the contribution's maxed at 25% of the employee compensation, and it cannot exceed the 58K. So the 58K contribution limit is the same as a solo K, but the individual would need to make more money in order to get to that max 58K, because again, in the solo K slide, we spoke about that first salary deferral component isn't a percentage of income. That could be the first income that you make in that year. So you'll also note with a SEP IRA that you do not have any sort of catch-up contribution if you're 50 plus years old. It's 58K whether you're 20 years old or you're 60 years old, 80 years old, whatever the case may be. So you're going to be working through that same 58K contribution limit there. Now with the SEP IRA, you actually have the ability to work through the employer's tax filing deadline plus extension. So again, we're not necessarily tied to the April 15th deadline. Certainly many business owners, depending upon their entity structure, have to file the business returns for somewhere between March 15th and April 15th, and then they're going to get either September or October extension deadlines. And so there may be an extension in order to get that contribution made to the retirement account. And again, that RMD is in place for the SEP IRAs because these are tax deferred vehicles like a traditional IRA. So the next one is a simple IRA. So again, sticking with the theme of a small business plan. So this has, we joke about this if you ever took statistics, this is kind of like a statistics equation. There's kind of different factors that flow into each other. And so typically when a client's opening a simple IRA, this is due purely to the guidance that they have been given by their tax professionals based upon the number of employees they have, based upon their goals for setting up retirement plans for the company. This is a very specific vehicle. So the contribution limit is $13,500 with a $3,000 catch-up provision for employees that are over 50 years old. Now, just like the SEP IRA, the contributions will be pre-taxed. So there's going to be either a matching contribution or a non-elective contribution being made by the business owner. So, excuse me, when you think about it, the eligible employee can make a salary reduction up to either that $13,500 or the $16,500 if they're 50 plus. In addition to that, there's either going to be a employee matching contribution element that's dollar for dollar up to 3% of the employee's compensation, or there's going to be a non-elective contribution of 2% of the employee's compensation with an annual limit of $290,000 in terms of the employee's salary at that company. And these are 2021 numbers. So again, this is a very, very specific vehicle. Historically, we don't open a tremendous amount of simple IRAs, but this is a vehicle that we've seen some clients utilize with some precise tax planning from their tax professionals. So also another kind of unique factor with the simple IRAs is that typically the plan must be established by October 1st in the year in which you want to make the contribution. So essentially, if the business, or the plan I should say, was established, let's say in November of 2020, very typically the retirement account would not still be eligible to make contributions for 2020. The exception with that being if the actual business was created later in the year. So again, a lot of moving parts to discuss with your tax professionals. Now, the contributions will be made by the employer using their business tax filing deadline plus extensions, so very similar to the SEP IRA. So it will be predicated on the business owner and kind of what they have going from a tax perspective. And as is the case with these pre-taxed accounts, the RMD is in play as well. So factoring that in if you're an individual that's 72 plus. All right, so the next one is Coverdale. This is something that we don't discuss quite as often as we should. So this is a tax sheltered vehicle where individuals, whether they're family members or friends, are planning for putting money aside for education purposes for an individual that is under 18 years old. So the contribution limit is $2,000 per year per child. So if you have 2 children, you could contribute $2,000 for each of those children. Keep in mind, you do not get any sort of deduction for making these contributions, but the monies do come out tax-free when they're used for qualified educational expenses. So many times individuals are using these to offset the cost of college for, again, family members or friends' children. They could also be used for whether it's elementary school, middle school, high school expenses as well. So there's kind of a lot that you can do, again, when working with your CPA, sometimes paying for a laptop, sometimes paying for tuition for those preliminary school levels can be paid for with the Coverdale as well. So many times what we'll see is that clients will have this as kind of an add-on account. So they might have some IRAs and 401K's with us. They decide to open these Coverdales and partner these Coverdales with these educational accounts so that they can grow these accounts in these loans that they're making, in the real estate deals, and the private equity offerings. So that's something to keep in mind. Also, if you're making a contribution, you need to be aware of the MAGI income limits. Interestingly enough, there's a income limit for individuals making contributions, but not for entities, trusts, things of that nature that are looking to make a contribution. So if you have a business, let's say you personally make too much income, but you have a business, that business would be able to directly contribute to your child's or your relative's Coverdale educational account. And these need to be fully distributed by the time the account holder, the beneficiary of the account, turns 30 years old. The caveat to that being, if there's some specific special circumstances, let's say that there's some sort of illness or impairment that the individual is going through physically, mentally, what have you, there's usually carve-outs where it may not need to be fully distributed by the time the child is 30. Also, if you have some rock star children in your family, they end up, getting full educational scholarships, athletic scholarships. They end up not attending college for a variety of reasons. You could actually then gift this Coverdale to other children in the family, maybe younger children or other family members spread out throughout other parts of the family. So it can be utilized for other children as well. And the deadline to establish and fund these accounts is April 15th, so we do not get any sort of extensions for contributions to this Coverdale account. And finally, we have the HSA, the Health Savings Accounts. So these are really unique vehicles in that you get kind of the best of both worlds. You get the tax benefit by making contributions to these health savings accounts, and you also get to distribute these tax-free for qualified educational expenses. So you get a deduction on the way in, and it comes out tax-free, which is obviously kind of a really unique scenario as it pertains to tax planning. And so the key is you must be enrolled in a high deductible health plan. And so you can see the stats on this chart. It needs to also state that it is HSA eligible. So not only is it a high deductible health plan, but it is HSA eligible, which is also just kind of the modern era of healthcare products and health coverage and what have you. So I'm not going to read all this to you. You can certainly pause this in a recording, but this is again kind of a unique vehicle. So in terms of contributions, you could contribute up to $3,600 for just simply an individual HSA, or if you have a family plan, you can contribute up to $7,200 to a family health savings account. So for any of you that are listening to this in real time, do keep in mind we have an upcoming webinar on March 22nd. So we're actually skipping this Wednesday's webinar. We're going to be actually doing a third-party podcast with an individual out of Atlanta. So we'll actually be doing it during that typical webinar time at noon. So please join us next week. We're doing purchasing rentals with your IRA and 401k. So we'll do a deep dive into that topic. We'll talk about certainly the utilization of these self-directed accounts and also just some things to look out for as you're looking at investing in rental properties, especially if you're new to that type of strategy. It can certainly be a tremendous way to build wealth. And there's also just, as with any investment strategy, just some things you need to be aware of. So any of you that are listening live, again, this was just kind of meant to be a quick shot little webinar here to get you prepped up for tax season. But if there's anything pressing, anything that hopefully we could bring a little bit of clarity to, certainly feel free to type into the questions box and we can go ahead and get into that. All right, so as those are coming in, so again, I'm Sean McKay with American IRA. That's Sean, S-E-A-N, at AmericanIRA.com. Our website is AmericanIRA.com, and our phone number is 828-257-4949. Okay, great. So do you have a few questions here? So the first one is, are IRA contributions tax deductible? So good question there. That will be dependent on the type of account. So if you have a pre-taxed retirement account, such as a traditional IRA, you may get a tax deduction depending upon your income limit. And certainly feel free to go back through those slides. With the traditional IRA, with the solo 401k, you certainly get those tax deductions. And typically with the small business plans, the SEPs and the Simples, the tax deduction will go to the actual business owner and for the business tax return. So it won't be a deduction for the individual employee. But that's a good question. Conversely, with the Roth IRA, for example, you will not get a tax deduction on there. So the next one is, can I contribute to more than one IRA or plan? So great question. And so you can technically have as many IRAs as you choose. So you could have a Roth with Vanguard, a Roth with Schwab, a Roth with American IRA. You could have it with all different types of groups, keeping in mind that the total contribution for the Roth IRA amongst all the accounts combined will still be the 6,000 or 7,000, depending upon the type of retirement account, or depending upon your age. So that's something to keep in mind there. Also, many times with employer-sponsored plans, let's say you have a 401k at work, that should not create any sort of issues with you making a full contribution to your IRA as well. So you should be able to max out your 401k as well as your IRA. But again, always speak with your CPA about that. So the next question is, how do I contribute to an IRA? So if you haven't already, we do have an application kit. You can utilize those forms, send that in with a copy of your driver's license to our office, and we can get your account established. In terms of making that contribution, you can either snail mail a check, you can send a ACH, you can send a wire, you can move over an existing retirement account that's not necessarily a contribution, but that will help to fund your IRA. So there are a few ways to make that contribution. Good question there. Perfect. Great. Well, it looks like that's all we have today. Really appreciate everyone's time. And again, if you have any ideas for content moving forward, if there's any topics you'd like for us to cover, please let us know, and we'd love to do so. All right. Hope everyone's doing well, and we will see you soon. Thanks so much. Have a great day.